Hey, everybody, welcome to our March 2026 market update. I'm going to jump right in. We have what I think is really some encouraging data for the outlook in 2026. So, as a refresher, we're looking at the 5 county area, which includes Wake, Durham, Johnston, Orange, and Chatham counties. New listings were actually up 15.9% in March. That is amazing. Year to date, we're up 7.2%. We need that inventory. We need people putting their houses on the market. And that's a really meaningful, almost 16% increase in a year over year compared to March 2025. So love that number. We'll talk more about that as we get into the video. Closed sales were up 3.5%. Anything in the positive direction, I'm really happy with. So we want to keep that trend line going. We want to outpace 2025. We're not going to be on pace for 2019 numbers. More on that later. That may or may not even be a benchmark that we are trying to get to. But when closed sales are increasing, that means there is more churn in our market. That's healthy for property owners. That's great for real estate agents. All around, it's a great thing. We expected that because pending sales data was up in February. Pending sales data leads to more closings in the months that come after that. So we're still down year to date, 1.5%. The closing activity in January and February was off. And so we are still recovering from that, but only down 1.5% year to date. Definitely something we can come back from. Median sales price up 1.1% year over year. Year to date, we're down just under 1%. I would say either one of those is healthy. If we end the year down 1% or up 1% or anywhere in between, that's really where I would love to see the market be at the end of this year. As I've talked about for a long time now, we need some really kind of flat pricing in our market for a period of time while the market expectations or pricing expectations catch up to where prices are. We're basically there. I'll talk more about that in a second, but I think anything in this range, kind of negative to positive 1% change in pricing in 2026 would actually be healthy for the long-term market here in the Triangle. Total showings were up 6% in March of this year over March of last year. You can see the whole numbers there. Showing activity going up is great, but even better is new pending sales. We're up 15.6%. Again, that's a really good indicator of what we're going to see in the April and May data as houses are going under contract. Keep in mind that if we get that people shopping for homes need listings to look at. So showing activity is up because our new listing activity is up. When there are listings for them to look at, for the home shoppers to look at, then we can have our pending sales go up, which then leads to closed sales going up. These are all really great metrics here to show that our market is in a healthy position and we have a really good outlook statistically for 2026. So super happy with these numbers. Inventory was up 14.1%. Again, that's great. That's a really manageable number. We still have plenty of runway to go to get our inventory levels up compared to what our market can absorb in terms of the number of buyers we have in our market. So you can see we're just over 6,900 homes on the market at the point in time when that was checked, and supply of inventory at 3 months. Again, very healthy, somewhat balanced market. So really just all great reassuring numbers here as we look at March 2026. Let's compare this to March 2019 just to give us our benchmark of pre-COVID, before the price spike, kind of what, again, maybe a benchmark we're looking to achieve. The equilibrium in our market may be different, but more on that later. Inventory back in March of 2019 was over 7,500. Again, we're only at 6,900. So still way more housing we can have on the market and have no problem with our number of buyers coming into our market here being able to absorb that inventory. So we could get even well past where we were back in 2019 and still be in a very healthy place. As you can see, supply of inventory back then was 2.6 months. For those real estate agents listening, if you were selling real estate in the Triangle back in 2019, you remember it felt like we had no housing. It felt like we had no inventory. So this 7,500 still represents an undersupply for our market. So still lots of runway to go. If you can believe it, the median sales price back in 2019 was $287,000. Again, we were at 440 in March of this year. So if we apply what I'm calling normal appreciation, so we have a healthy, desirable market, so I'm calling that 5.5%. If this 287,000 had appreciated at a rate of 5.5% over the last 7 years, then the price would be 417, 493. Again, we're at 440 now. If we apply this 5.5% appreciation for one more year, that gets us almost exactly to 440. That's why I talk about if the housing market, if the prices can remain somewhat flat for 2026, then by the time we arrive to March of next year, the housing prices will be where they would have been had we never seen the COVID spike in prices. So what that means is that the consumer expectation now is in line with what things actually cost, or what housing actually costs specifically. And I think we're really already getting there. Anecdotally, I know that as real estate agents and consumers are out there looking at, say, a $500,000 house, it feels more or less like a $500,000 house. So that's great. That's what we want. That allows the market to get back into kind of a normal rhythm. So another exciting sign there. New listings hitting the market back in 2019 was 4,000. We actually outpaced that. So we actually had more listings this March than we did in March of 2019. That is fantastic news. It's the first time that's happened in quite a while. So we're excited about that. Closed sales, 2,875 back in 2019. Again, just 2,269 in March of 2026. So we're still behind the 8 ball here on closed sales, but a lot of really good metrics showing up here in terms of showing activity, new pending sales. So that's great. If we look back at pending sales in 2019, though, 3,460. So still outpacing where we were March of this year, but that's okay. Again, we're not going to catch up to 2019 numbers overnight. We want to continue to have positive movement in that direction, which we are seeing across the board here. So let me jump into some of our charts just to kind of give you a different visual of what we're looking at. These are the inventory levels. The blue line being 2019, orange was last year, and green is 2026. Here we are right in the middle, a good place to be. And again, we're possible we could outpace 2019 as we get through the year. But as long as we continue seeing this trend line stay above last year, that'll be a good thing. That'll be what we're looking for next year. Again, year over year, we want to just continue to see improvements. Looking at new listings, this is year to date. So the total number of new listings that are hitting the market. And you can see, other than in January, we started off the year slightly below 2025 numbers. But in starting with February and continuing widening the gap here in March, we have lots of new listings coming on the market. This is a great thing. If this green line, which again represents this year, if we see that surpass the blue line, which is 2019, I would say that's a really great metric. So if we have more people putting their houses on the market, that's what we need to create the churn that's going to be healthy for our market. Looking at closed sales, this is a monthly basis. So you can see we were behind 2025, both in January and February, if you look at those months isolated in a vacuum. And then in March, we surpassed where we were last year. And then when you look at year to date, we are still slightly behind. Again, just 1.5% behind year to date numbers of 2025. Based on the showing activity and new pending activity, I fully expect that in April we will surpass 2025 total year-to-date closed sales data, and then we will continue to bridge that gap as the year progresses. So this will be a fun one to watch as the year goes on to see how close we can get to this blue line. That's the ultimate goal is to get back to those levels. Hopefully that will be what becomes our norm. So. All right, looking at new pending sales data. Again, this is typical. You see a big spike up between February and March. That's why you see that in 2019. You saw it last year and you saw it this year. Where we top out, that will be really kind of an interesting thing to watch. Would be typical for pending activity to fall off a little bit in April, pick back up in May, usually peaks in that April or May timeframe in our market. So again, just a great visual to see where we are, that we are surpassing 2025 in this metric and hopefully getting close to 2019 numbers. All right, let's look at this new listing to closing ratio. This is one that I really enjoy looking at. This kind of tells you how painful does it feel for sellers out there. Interestingly enough, this didn't change from February to March, but I do want you to note that early in the year, this number is always going to be higher. That's just a matter of at the beginning of the year, you have fewer closings in January and February, but you have the market starting to pick up. So more people are putting their houses on the market. So you have a higher numerator for our math majors out there because you have more listings coming on the market. The closings haven't caught up to that yet. And so that ratio stays a little bit higher. And so 1.83, that will come down certainly as the year goes on. But again, we want those new listings. We need the new listings. We just need buyers to still take action. And I think this number will continue to come down. It's not as bad as it seems. If you look at 1.83, you say, gosh, that's as bad as it's been since, the second half of the Great Recession. It doesn't feel that painful out there. But this does tell you that when there is more competition for listings, houses tend to sit a little bit longer. This is reflective of that to some degree. But again, as prices remain flat, more listing options become available. Buyers enter the market. As buyers enter the market, that starts to bring things back into balance where home prices can go up. So it's a well-oiled machine when it's working properly. But what's really going to determine if buyers are coming in the market is this one. This is the Housing Affordability Index. This is what I've told you for years since I started doing these videos. If you want to know how the market is doing, look at this number. It's really been great. This number has been improving dramatically since the fourth quarter of last year. So that's been really encouraging. And I put these numbers into a chart for you as well. Remember, the Housing Affordability Index, an index value of 100 means that the household with the median income can afford the median priced home. They make 100% of what they need in order to afford the median priced home. So over 100 is good, means homes are making more than they need to afford the median priced home. Under 100 is not so good. It means they're making less than what they need to afford the median price home. So it's just a good indicator as to what the general buying public, how housing is affordable for them, how it's accessible for them. So this dates back, this chart here, to January of 2019. We have data going back to 2006, but I'll just spoil the surprise for you. It was high all the way going back to 2006. It was always in the 130s, 140s, 150s and above. Very affordable in our market. It wasn't until the decline actually started around January of 2021 that we came down, and then we get here into the middle, early parts and middle of 2022, where we actually crossed below 100 for the first time since the index, at least in this market, has been tracked. And so what's really interesting here, and I just want to point out, this is the first time I've charted this, and one of the things I want to point out to you is in January of 2021, things were going gangbusters here. Houses were selling super fast in less than a day before they even go on the market, sight unseen, multiple offers. It was crazy. But if you fast forward and you look here just 6 months later, July of 2021, what a drop off here. And if anyone was paying attention to this, you could have started to see those warning signs and said, I mean, we knew back then it wasn't sustainable, but it was becoming very clear that housing was not affordable. There was a lot of money that went into the economy in 2020 to help stave off the impact of COVID. And so that money got put to work. And people started buying houses. House prices started going up. Now, during this time, interest rates were still really low, still basically free to borrow money. But housing prices were going up, so affordability started to suffer, and it just kept tanking. And then, of course, in the middle of 2022, mortgage rates went up. So now you had high prices, stubbornly high prices, and rising monthly expense with mortgage rates being so high and wage growth being stagnant. And that has left us in this terrible position where housing has been so unaffordable for the last 4 years. But we now start to see it go up. So just like if we were watching this back in 2021, we could have seen the warning signs and said, hey, this is really becoming a problem. This might lead to some real economic issues. We look at this improvement here along with what we're seeing in the other data with pending sales activity, closed sales, new listings, showing activity. Even though mortgage rates haven't come down meaningfully, the fact is that wage growth has outpaced the cost of housing growth. And so that is causing affordability to improve. So I'm not predicting the future, but I'm seeing this run up here in affordability. And the way I look at it is that if homes are becoming more affordable, then buyers are going to want to enter the market as housing is affordable or becomes more affordable. Eventually, that leads to housing price increase again. So, really, potentially a great time to be getting into the housing market after we've seen flat prices for the last several years. There is an opportunity here where pricing hasn't started going up in a meaningful way yet, but we certainly could be in the beginning stages of getting back to a healthier home price appreciation. So just a little nugget, something for you guys to watch. Hopefully this information has been helpful for you. As always, if you have comments, put them in the remarks below. Would love to engage with you. Thanks, everybody.